Hello, this is Jeffrey Kleintop, Chief Market Strategist for LPL Financial, with our Outlook 2013 entitled The Path of Least Resistance. In 2013, many different forces will combine and influence the direction of the markets to follow the path of least resistance, leading to modest single-digit returns in the U.S. stock and bond markets. There's an old saying that following the path of least resistance is what makes all rivers, and some men, crooked. That probably applies to markets as well. Not necessarily the dishonest part, but we don't expect the path taken in 2013 to be a straight line. There are a few different paths with sharply differing outcomes that might be taken in 2012. Key steps down the path for the year may be taken at the end of 2012 or in early 2013 as critical decisions are implemented. We believe the base or most likely path will be the path of least resistance, driven by several forces. First, Washington will likely finally rise to the challenge of this self-imposed crisis and form the compromise between the parties that will meet the least resistance, extending some of the Bush-era tax cuts and canceling some of the scheduled spending cuts. Second, the path of least resistance among Fed decision makers is to continue the current bond buying program and take the time to see if more aggressive stimulus is needed or if the economy can stand on its own. Third, major hurdles to further European integration overcome in 2012 set the stage for progress towards slow, continued integration. And last, the U.S. economy faces the weakest global economic backdrop since the Great Recession of 2008 and 2009, as we head into the looming fiscal drag of tax increases and spending cuts. These forces bearing down on the economy are opposed by others, including the benefits of Fed stimulus, the rebounding housing and stock markets, and the lifting of business uncertainty as the budget decisions are resolved. The combination of these forces could result in different paths, but is most likely to lead to flat to weak growth for the U.S. economy. For the markets, the path of least resistance is likely to include modest single-digit returns for stocks as sluggish profit growth dampens stronger returns. But prices are supported by low valuations and improving clarity as uncertainties begin to fade. Bond yields may rise only slightly, restrained by sluggish growth and a Fed committed to keeping rates low. The base case path to a deal may not be a straight line, but it's the outcome we view as most likely. However, the stakes are high, and there are paths that differ widely from this base case outcome. A bear path, we believe, has a 20 to 30% chance of taking place, and a bull path, we believe, has a 10 to 15% chance. Let's focus on the bear path for a moment. With the S&P 500 having risen back to within 10% of all-time highs in October of 2012, and the high end of a 15-year range, markets seem confident that the Senate Democrats would quickly find a compromise with House Republicans to avoid going over the fiscal cliff. However, a compromise may be hard to reach. Remember, the gridlock in Washington was no help to markets in 2011, as the unwillingness to compromise on both sides of the aisle led to the debt ceiling debacle in August of 2011. That sent the S&P 500 down over 10% in just a few days, despite the ultimate increase to the debt ceiling. A bear market and recession favoring defensive investments like municipal and treasury bonds could be looming if policymakers choose this path. On the other hand, there's room for some guarded optimism and a bullish path. If there were ever a time to enact long-term fiscal discipline, now is that time. The United States' large and unsustainable budget deficits helped push total U.S. debt over 100% of GDP in 2012. Wide-reaching, bipartisan proposals have been unveiled to put the United States back on a path to fiscal sustainability. A long-term solution of permanent changes to tax cuts and entitlement programs, as well as ending the battles over the debt ceiling, could emerge in 2013. This path would be welcomed, with a bull market led by economically sensitive cyclical sectors and small U.S. company stocks as it lifts the uncertainty plaguing business leaders and investors alike. We believe the most likely outcome is that the battle in Washington will result in a compromise that averts the worst-case outcome. But the negotiations themselves, coming on the heels of hard-fought election battles, may drive market swings. Fortunately, the lowest valuations for stocks in 20 years may help to limit downside and create potential investment opportunities. Which of these three paths will prevail is largely driven by the compromise, or lack thereof, in Washington. It's worth noting that the path we start down may not be the one we end up on. There may be many twists and turns on the way. For example, the market and economic response to a journey down the bear path could ultimately prompt a long-term deal that leads us back to the base or even the bull path. So going over the fiscal cliff, while scary for market participants, does not mean the U.S. economy necessarily crashes on the rocks below. Even then, it's not too late for policymakers to come together and rescue the economy and investors. At least it won't take us long to find out where we're all headed. Which of these three is the path of least resistance is likely to be determined by the end of the first quarter of 2013. Thank you for listening. For more insight into our outlook for 2013, you can read our detailed white paper. Thank you for your business.